Afternoon, everyone. So this session's on returns, kind of relevant given the event, Super Returns, Super Venture. So when I was first given the panel returns, I was thinking, so the challenge here, especially after talking with the panelists, is I think basically people are just going to want a number. And then we're done. Or go to lunch. Or it's going to be, well, it depends. And which is an answer that I often struggle with. Until I saw who the panelists were. And then I thought, okay, this is going to be a good discussion. And so I'm thrilled with this, with the panel. I've had conversations which will bring out some interesting topics, I hope, and then we'll stop for Q&A. So hopefully by the end of this, you'll realize this was the best session to attend. But let me introduce the panelists. Alex Bangash at the end, who has actually been a panelist here last year, Managing Director and CEO of Trusted Insight and TI Platform, full stack institutional asset manager, has been called in other presentations the LinkedIn for LPs, machine learning driven platform, hosts the world's largest network of institutional investors, and he has a track record of investing in over $1 billion in 50 plus funds for institutional investors with an IRR of 30% plus. Here's your first number. And advised first checks into Excel, first round capital, founders fund, emergence, Y Combinator, and there's a very long list which would have kept me here for another 15 minutes. So welcome, Alex. Ian, just on my left, Managing Director of Funds, runs the investment team at British Patient Capital, a commercial subsidiary of the government-owned British Business Bank. Fun fact, Ian recently completed his 50th fund investment, taking him to over $1 billion committed to venture and growth funds. Well done. And then Reshma, Sohoni, founder and partner of Seedcamp, a brand I think most people in this room know now. Pre-seed and seed fund across Europe, multi-sector, Fund 4 now being deployed, 60 million in size, over 300 companies in the overall portfolio with standout companies including TransferWise, UiPath, Revolut, and recently on the Forbes Midas Europe list, although they only launched 2 years ago, and they put first checks into their companies, 3 of which are unicorns. So it's quite a nice place to be if you're the first check into one of those. And actually, they were started by VCs and angels rather than institutions. So quite a breadth of experience around, and which is why I want to make sure that we have time for Q&A. And I'm going to, by the way, encourage, we already had conversation, I'm going to encourage conversation up here. So if this breaks down into a melee, it's because I've said it's a good thing. So I want to start with a high-level sort of possibly softball question, 60,000 foot, which is, I mean, right now, we are in turbulent times. Brexit, rise of populism, future of the EU, the swing factor that is Putin. Do people value science anymore? Do people know what, trust is anymore? And in fact, in these turbulent times, we saw at the first presentation, the review of the venture capital cycle, for those of you who are here, which actually was almost an indication that are we entering this next phase in that cycle, which is a phase of conservatism rather than accelerating. And so my first question, to the panel is, so should we still be optimistic, or is now a time to kind of hold back? And I suppose the only addition I'd add before starting the conversation is, I'm expecting the answer to be we should be optimistic, and then the question is why. Ian, do you want to kick us off?
Well, I've got two, in terms of that potential lurch towards being a bit more conservative, there's probably 2 things we're keeping an eye on. And one of the reasons it takes such a long time to form a view of this stuff is it takes a while for the data to catch up, but there's probably 2 things. Number one is how much capital is deployed relative to the number of deals that get done. Because one of the things that we were noticing was there wasn't as fast a rise in the number of deals as there was in the amount of capital. And that could just be the maturing of the ecosystem. It could be lots and lots of things. But it also could reflect investors being a bit more conservative and shifting towards more established late-stage companies. And then related to that is a second point around how many venture funds actually close. The amount of capital that's garnered is from the data that we've seen so far anyway, looking okay. But actually across how many funds? Because again, anecdotally, one of the trends that we can see is fewer funds, but they're bigger, which again then feeds into the kind of ecosystem. Slightly fewer deals, but overall more capital deployed. So again, in terms of that barometer of how risky or otherwise is the ecosystem feeling, that's two things we're keeping an eye on. Good.
I mean, I guess, I agree with sort of the couple of speakers before, which is we don't think technology is cyclical. We think it is structural. It is causing widespread technological sort of revolution, right, across every industry you can imagine. Being investors in things like TransferWise and Revolut on the financial services side, to UiPath, which has grown from 3-4 million in revenue to a 200 million ARR business in 3 years, and with customers like Walmart and CVS, and so hugely impactful across some very traditional industries that are slow moving, slow to adopt technology. So you see that, and that's structural. It's not just a flash in the pan. So I think that's we're firm believers in that, and I think secondly, also to what's one of the key things from Brajesh's presentation is, we do see so much private capital. And as the first check-in, we've got 6 rounds ahead of us, and we're still sort of seeing a lot of money chasing our companies. And I've been complaining a lot about getting calls from brokers every other day to get into these sort of UiPaths, Revolut. So if you're out there, you can come find me. So there is so much of that capital, and it's patient. It's willing to wait the long term. So we're quite optimistic from where we sit. Obviously, any major sort of shocks in the system will have reverberations. But again, I think what we're seeing is our biggest companies are extremely well funded for the next 3 years. So they have runway to last the next shock. The companies where they're not as well funded, we're certainly worried about. But I think in terms of our returns, which we'll get back to, they're driven by those few companies, and they are well funded for the next 3 to 5 year time frame.
Cool. So in general, I agree with what Reshma just said about this being a secular trend. Tech is a secular trend, and I think many of those companies, just like 15 years ago, there was no Facebook. So many of those best companies, and this is across all sectors, those haven't even been formed just yet. But what I will disagree with, respectfully, is that this is not a good time. And I think probably just in this thing, there are a few LPs, and I've been speaking with some who for the first time are now investing in venture. And so when you ask them, we said, okay, well, how is your venture, misadventure coming along? And they will say, well, gee, we invested in 1999, then we got out of the market in 2003, got back in 2005, got back out in 2008, and now we're coming back in. And by the way, we want to invest $5 billion. So I think a lot of that is happening. And I think they're also investing in the worst type of startups. So with exception of great companies that Reshma has funded, like UiPath and Revolut and others, who have been capital efficient. What is actually happening now is that many LPs and many VCs are now solving, instead of creating lean startups, they're creating fat startups. So they are solving business problems with capital. But if you look at Google, they only raised 1 round of financing. Airbnb, and those of you think that Airbnb is a capital intensive company, they raised $3 million, sold 5% of their company in Series A. Why? Because they did not need capital. Right, so today when sovereign wealth funds come to you and pensions come to you and say we want to seed, we're leading a Series A with $250 million, I think there's only one outcome in those kind of scenarios. There is going to be a downturn. There's going to be a lot of pain, and most of the people totally agree it's a secular trend. But now, within that secular trend, there is a cycle. And we're at probably, who can call the top, but we're probably at not a good vintage.
Anybody want to jump in?
Starting today, you mean?
Today.
If you started 5 years ago or 10
Well,
years ago,
I think that's one of the things that, I think that's one of the things that we've done. Actually, seed is the number of seed deals have decreased. That's because seed has become too noisy. It's just there is no single, and people will always say, well, this person has great investment judgment. Nobody has great investment judgment to find the right sector, this time, I don't know how many companies you will have, Reshma, but YC will have 250 companies at their demo day. Which investor can listen to 3-minute pitches from 250 companies and pick out the next Airbnb? Who's the winner? YC. YC is the winner, right? So I think those type of structural changes are actually happening in venture. That's why we invest in platforms, and we've increasingly invested in studios. So with these studios, we are going direct. We are circumventing the VC, going direct to the entrepreneur, and having the entrepreneur create a portfolio.
So with that as background then, and getting into the number question. So for you, what does good look like? What is both the return expectation that you have, and why? Alex.
Oh, you want me?
Yeah.
I thought. So I have a different viewpoint. So Warren Buffett likes to say is that the rising market makes everybody look like a financial genius. So all of us here are looking like financial geniuses. Well, it's been because the market has been rising for the last 10 years, right? So I think what you will actually see is, you will see the real results when there is a downturn. And venture is really, really stark. It's unlike any other asset class, and that's why you will rarely find a great private equity investor who's a great venture investor. Why? Because private equity is all about consistent returns and the median and average returns being good. Venture, either you're spectacular or you're bad. There is no good. So this thing should be changed around. So if you're not in spectacular funds, if you're not one of those, you will not be good. You will be bad. And that bad is not evident right now because of where we are in the cycle. Everything looks good.
And your number is?
That said, right. So that said, though, you need a number still at the end of the day. And
But that number is definitely not 2x, that's definitely,
Right.
and I will not, sorry, and Chris, I will tell you, and I'll not name the fund, right now there are top venture funds. So when I was starting out in this business, I met one of the top funds. It was one of the top 5 funds. So this really elderly gentleman, he sits me down and he's like telling me how he built one of the most iconic firms in Silicon Valley. And I asked him, I said, did you invest in Facebook or did you invest in Google? And he was like, we would never invest in Facebook. This is 2005, by the way. And he said, Alex, I have a franchise. I am not going to lose my money on something like social networking, right? And guess what? That firm is no longer in existence, but it's no longer considered a top 5 fund. It's because once you build a franchise, you start playing defense. You say, well, I can't do, frontier technology or frontier geographies. Why? Because I want to consistently perform 2 to 3x. Venture is not a 2 to 3x business. You have to aim for 10x to be in business.
So unpacking that a little bit, I mean, for us, 10x isn't even good enough. So, we're investing in about 100.
At a fund level, not at a company level. At a fund level, not at a company level.
So I mean, so unpacking that a little bit. So at a company level, for us, 10x doesn't make it, right? And so I'll get into fund level. For us, it's 500x, 1000x is what really kind of makes us top few firms or a top decile fund. So when we look at it, and we talked about it a little bit with sort of TVPI, IRR, and multiple. We look at all of those things. So 3x sounds really nice, but if 3x took you 10 years or longer, that's not so great with IRR, right? And I come from Wharton, so school of IRR, basically. So we obsessively look at IRR, and we're looking a lot at speed. So I mean, our first fund getting to 3x took too long. It was also not optimized in terms of our strategy. We started to get into the right strategy, we think, very much in 2 and 3, and that's where, you know, when we got to the first fund, 3x took about 10 years. The second fund, 3x took 6 years. And the third fund, 3x, getting to 3x has taken 3.5 years. So, I mean, that's where we're sort of obsessed with, and seeing, you know, 500x, 1000x. And that's where we can get to see 35, 40. Right now we're at like a 50% IRR. You know, may the good times continue on that front. And we're thinking about liquidity, therefore, is protecting that 40, 50% IRR and driving to actual cash-on-cash results, you know, around that. But I think, you know, definitely for us, if we do anything below 25% IRR, we would consider ourselves unsuccessful. So that's what we're driving towards, is 25% plus, but ideally in that 30, 35, 40% IRR for our LPs, and driving to a liquidity event around those benchmarks.
Nice. So we're getting some numbers out, but your answer is going to be more nuanced, isn't it?
Well, I mean, first of all, just to pick up on a couple of points, I think in terms of a point that Alex made around the dispersion of returns, actually there kind of comes a point for some LPs that we talk to in other environments where just that fact alone, it doesn't really matter what the really good looks like. The fact that the bottom can be quite quite not so good in venture, that's just a turn-off, and it doesn't fit with their mandates if they're liability-driven investors, for example. It just might not work. So in a sense, there's no return expectation we can conceive of here that's ever going to change their mind or mandate, which of course is one of the reasons we exist. And in fact, it's no coincidence, I think, that Alex and I are both venture specialists. You know, we don't invest in other asset classes, right? In terms of Reshma's point, actually, again, it's been our experience that those kind of three metrics of TVPI, so the fund multiple, DPI, and IRR, it's really hard when you look at a fund at any point in time to be scoring really well on every single one of those things, because either you've sold quickly and IRR looks great, but the multiple suffered, or vice versa. So actually to hear that kind of stagecraft actually of and it's part of the learning of how to be a venture manager, if you like, earning your spurs is how to generate great fund results, because it's one thing aiming for great company results, but actually turning that into a fund, and then to add our perspective. So we're a fund of funds, so we're trying to actually generate an outcome net of all of this stuff. So the great funds and everything else, and what does that look like? And so for us, actually, part of it does come from not always trying for the same thing. So actually, in our portfolio construction, we don't always select funds that are swinging for the fences all the time, if you like it, that are going for very big outcomes. And there is room in the portfolio for the kind of more middle of the road stuff where you're generating slightly more. The dispersion's less, but the outcomes are slightly more defined and known. So for us, it's in a sense our returns look a bit like the indexes. You know, so if you benchmark returns, you know, we're aiming for a return that's in that range of what the industry looks like somewhere.
So you're saying a number of funds that are being successful, but play against a different goal seek than.
Yeah, exactly right. So a balance of early and late and different, and we do life sciences as well. So not just ICT. Right. And landing that in a place that looks attractive commercially.
So in terms of operationalizing that, so we've had some numbers in terms of, you know, where we're heading, but in terms of actually turning that into reality. So it seems to me, in all the conversations I've had, you've got these two competing forces. On the one hand, there is a much greater discipline, research, science around trying to be algorithmic, trying to actually use science to be smarter about investment decisions. On the other hand, as you talked about, it's almost this pull back into, you know, seed, pre-seed, get in earlier, being part of that. Now, the earlier you go, there's less science to go on. There's less, I mean, the product might not even be live yet. There's no app store data. So is operationalizing this more art or more science or both?
I mean, it's definitely, I would say, it was interesting to listen to the panelists talk about kind of, employing machine learning and into their practices as VC firms. I mean, yes, we're doing first check-in into companies like TransferWise and Revolut when, as TransferWise says, they were a fake business. They weren't even live yet. And so, when you're doing due diligence on that, I mean, it is really people, right? It is much more, it's much more art. I think the science we implement when we look at anything pre-product where there's no data to really go on is the science around sort of the network effects and how we found those founders, through what networks they've come in, what kind of network effects they have as people. And then on the other side of when we selected those companies and we're putting them in a support infrastructure around our Seedcamp platform, again, it's extremely network effect driven. So how much can they contribute into that platform? How much can they put into that system and really help their peers and buy and sell and create an economy? So we really look, in our platform at least, we look to create an economy of our companies, recruiting from each other, buying and selling into each other, and connecting their enterprise customers to each other, and so on and so forth. So I think that's our science, is network effects driven,
right,
rather than a whole host of sort of app store data or Stripe data, all kind of tech stack data that we just don't have because they're very much often pre-product, pre-launch.
Right. And I think tying into your thing, your answer there, Reshma, we've seen the same thing happen. So we focus only on platforms which have network effects. So right, I think there is, there's clearly value to that. We're even seeing a company that had a Series A from Andreessen, and it decided to join YC. Why? Because they said that's the easiest way for us to get customers. And I wish I was making this up. No, So that kind of tells you how once you get these network effects, they can be so powerful. But the other thing which is actually happening, and I think this thing is venture itself is getting disrupted. And I think a lot of people in this room don't want to hear that. It is the platform network effects are now stronger than brand effects, and now there's this new, I would say, new emergence of studios. And studios, what they're doing is they are now, for the first time, allowing LPs to go directly to founders. So now you don't have to go to a VC, Mr. VC or Miss VC, build me a portfolio. The founder can then build a portfolio. Because of the cost of companies has gone down, they can build accumulating advantages, and then lastly, we think it's not so much the algorithms. By the way, we have a staff of not in TI platform, but on Trusted Insight Funds Studio. We have something called Fund Studio, and we have 15 engineers working, building software, both workflow software as well as software for LPs and GPs to identify breakout companies. And so there is a great need for all this. But we don't think it's so much the algorithms that you build, it's actually the data that you have. So just as we speak, we are anchoring our first API-based fund. So what an API-based fund does is you might have, say, an Uber app. So the Uber app is built on Google Maps, and I'm just generalizing Google Maps, Twilio, a Segment, and Stripe. So it actually measures. So this is a machine voice API, and so they measure the activity of the apps that are built using that API. And I think those kind of systems will be much better than the investment acumen of any single person. So I think we're going to see more and more. Someone Oren Hoffman wrote an article, and he said if AWS had a venture fund, they would probably be one of the best investors because they would be able to measure everybody's, or Stripe. Stripe is now investing.
Investing, yeah. I mean, that's really powerful. Actually, is they're not corporate VCs as such, but UiPath has now a fund to invest in the whole UiPath ecosystem. The company didn't exist 3 years ago. Stripe is a very active investor in startups and really enabling companies that they want to see actually survive and be alive down the road for Stripe's benefit. So it's in a lot of different directions.
And I think from our perspective, that the panel earlier made me smile actually, because it feels we feel a long way from being algorithmically driven. I think pity the poor kind of LP that has to. I mean, it's blind pool investing, so it's as clean a vision of the future as it gets, and the existing portfolio is in some sense a lagging indicator of success. It's what their team has done, and you're trying to project forward. And for example, if the team's raising more money, or there's team changes, or all sorts of things, how do you go from what's gone before to what's going to happen in the future? I think data and data-driven decision making is super helpful for the portfolio. Actually, from an LP perspective, really figuring out where the really great companies are and what you've got in the portfolio and where you can build up exposure. I think that's super helpful. It can be quite helpful in determining whether a fund you're looking at is going to go on to outperform, and therefore whether this team might be any good. But in the end, actually, we still rely disproportionately, I think, on meeting the team and doing the kind of the more traditional stuff, actually.
It also sounded like in one of our conversations, going back to the goal piece, you said actually one of your goals is as a catalyst and champion of the ecosystem.
Yeah.
I think were your words. And actually, you then, the math around how you compose a fund, where almost, a fund that performs poorly, you do better, and a fund that performs well, they do better. Is that still a construct that you use to try and encourage the right behavior? And
not within British Patient Capital, no,
Right.
but elsewhere in British Business Bank, we have a program that works exactly like that,
Right.
and it's designed for all sorts of reasons to incentivize the other investors alongside the bank.
Right.
To select managers that they think are going to outperform, because otherwise, why would you do
Yeah.
it? If you're not going to do so well. But
so let me. I think we started late. I don't know how much time we've got. About 10 minutes. 7.
3 minutes.
3 minutes, 27 seconds. It says down there.
Oh, is there time?
Yeah.
Oh, God.
But nobody wants lunch.
But-
They just
yeah.
want to sit here.
Nobody wants lunch.
So
But
we
this
can
is,
go on.
This is really good. All right, so we're gonna do one quick one, and then we'll open it to questions. So very quickly. I mean, look, all of you have been in these roles for 10 years or more, and so have as pioneers, and so have a lot of experience. So if we look forward a little bit, and we talked about technology as a secular trend. If we look forward a little bit, and we're sitting here 5 years from now, what are we talking about? What is the shape of things? Are the answers different?
I mean, I doubt there's anyone in this room who would say we're not going to enter a shock period, a downturn, right? So we all hope. I don't know what the world looks like without one, because it's already kind of crazy place. So so where will we be in 5 years? Hopefully, the best of us will have, again, found liquidity for our LPs while the times are good, to some extent. I think also we will have some discipline with helping our companies to raise as much as they can now and actually conserve capital and be efficient with their capital to really to be the last company standing in their sector. As things are more and more winner take all as well, is that last company standing in that next 2, 3, 5 year time frame. And so in 5 years, hopefully, these outliers in our portfolios will continue to be those. And I hopefully am not telling a very different story, in that. That said, I know generally a third of our portfolio fails, but we're very prepared for that number to rise to 2/3, as long as the top 10% of our companies are 1,000x, 500x, 600x. So.
Yeah, I think most of us will definitely looking back 5 years from now. Most of you will see that there is a lot of noise right now. Those of you who are LPs, you can take a meeting with VC funds every day and not even scratch the surface. That many VC funds in Europe, US, China, fundraising, India. So how can you cut through the noise? I think returns is one way that you can cut through the noise, but that is backward looking, because the things that have done well, the geographies that have done well, may not do well in the future, the sectors that have done well. So I think the forward-looking question, it's a very simple question. That's what I ask myself. will this firm or this company be the most significant? Could it be the most significant fund 5 years from now? And if you ask yourself that question, all of a sudden this noise, it whittles down, because most VCs, and that's why there are entrepreneurs like Reshma and EF and YC and Recent. Most VCs, they don't do firm building, so they are very good at giving firm building advice, but they will never use their own advice on themselves, right? The one partner will keep all the carry, and they will have generational issues. And that's why, when most LPs, they invest in those things, they just look at a series of numbers and they assume the same thing will carry over. Actually, there are no accumulating advantages, there are no network effects. And tying this back to get spectacular results, you have to then bet on those firms that are actually preparing for the long term.
Yeah, and I agree with that. I think that's right. I think one of the trends we've seen of this consolidation of capital in the better GPs, I think, might continue, but on the premise actually that you're absolutely right, that they continue to build their firms to be able to deliver and deal with the succession. And if I think about the managers that we know very well, actually a few of them now have been in the market and operational for 2, 3, 4 funds, and they're just coming up to that point now where generational succession and building a firm that's going to outlive the founders, how that's going to work, how they're going to bring more talent in, all of this stuff, I think. And the people that can do that and continue to fundraise and generate the results, actually you'll see them, I think, continue to raise capital. And you see the kind of emergence of winner brands, if you like, from the European ecosystem.
Comments and advice not always easy to follow when you're actually doing it.
Well, indeed.
Questions? Given that amount of time.
Well, I just wanted to thank Alex for reminding me why Joe Shorge and I, all those years ago, actually started Isomer Capital, for exactly those reasons of how LPs sort of think about this in a sort of a rather transactional, sort of short-term way, and don't think about building companies. I mean, what is one of the third, and only third because there's 2 in front and they're sort of, they're linear, right? They're not sort of horizontal. Is, can we work with this team? Can we help this team? Can we build this team be successful over the long term? And one of the really fundamental questions we ask is, how are you going to cope when there is a serious downturn? Because the one thing that you have said that is absolutely accurate is there will be one at some point.
Did you
Great. We have one more question over there, I think.
Yeah.
Thank you, panelists, for your comments. A couple of comments and a question within my comment. So I take the point of view, I'm a former partner in Latin America's oldest venture capital firm. So I invest in Latin America and Europe, North America, and also in Asia now, myself. But my question is, do you look at it where, is it more important to get funds that are, let's say, funds 3 and 4 and look for relative value throughout the world? Or are you going to continue to invest in funds as they grow bigger? And I would actually argue they lose some of the alpha as they're growing bigger. So I'd like you guys to comment on that. Thank you.
So, I'll tell you, we were lucky enough to invest with some firms like Founders Fund, which grew bigger, and their returns continue to be spectacular, right? So I think it all depends on how you change your strategy. Some people can do this. They can, they can generate as spectacular returns as Reshma on billions of dollars. So I don't think there is hard and fast rule to that. And firms like others, they have to reinvent themselves, just like companies pivot and they reinvent themselves. Firms need to reinvent themselves. So I don't think you can be dogmatic about it. In a lot of cases though, firms that raise capital for just the reason of raising more capital, I think LPs would be well served running away from that.
Yeah, fantastic question. And we spend a lot of time actually now thinking about, we used to think a lot about what the minimum size of the fund was to make sure that it was vital. And now we spend a lot of time thinking about what's at the other end, how much is too big. I guess for us in terms of where we're at, actually there's still quite a lot of room to grow in the ecosystem actually where we've historically invested. So we've not bumped up against the kind of upper limit that sort of.
So you don't have a number yet on what is too big?
No, and to the extent that work has been done and the data that I've seen, I think most of the funds in which we're invested are comfortably away from that yet. But it's a really great question.
So I've been given sorry.
Just a last point. I mean, coming up from the other end as a GP, pitching a lot, I think the worst conversations we have are with dogmatic LPs who've been LPs for decades. And have sort of a Bible that we don't adhere to, and we're trying to seek alpha, and you don't get alpha if you're sticking to a Bible. And so I do think folks like Isomer and Alex are thinking LP in a very different way, and those are the best conversations we have, because you actually get into why you are hungry as a GP, why why you're not being driven by fees. So we don't pay ourselves very well actually compared to what I hear at top firms, but we sold our first 2 funds to Draper, and the carry was exciting, right? And the carry is what really drives us. So, and if you can dig into that and get excited about that with us versus just increasing your AUM and being driven by fees, you're going to get what we do, and you're going to probably get the alpha. But I do think a lot of LPs have been doing this for 20, 30 years, and it's like, well, this is my Bible, and you don't look like this. So.
Thank you. So I've been given the nod. I'd like to thank Ian, Reshma, Alex. I think we delivered on the exciting panel bit. Thank you very much.